Hi, everyone. I'm Christopher Thornycroft with Redwood Logistics, and welcome to the Redwood Rundown. Coming to you live from the Southeast Association of Rail Shippers Conference taking place in Savannah, Georgia. Let's just talk about the market. Let's not say anything at all about Bears versus Packers because that was the worst thing in the world. Let's just talk about the market. The outbound tender rejection index is sitting at 4.3 to 1. That means that there are people that are starting to increase what they are pushing on back because those contract rates have gotten to the point that they can't actually absorb them. At the same time, that's still pretty low. Why? Because again, for the millionth time, because the contract rates are sitting about at 50 cents higher than our spot rates. At the same time, you have the DAT, load to truck ratio, that is above 3 to 1. That's above equilibrium at this point in time. Now, is that because of the Labor Day holiday and truck repositioning? Yes, that's absolutely because of that. But at the same time, we are seeing the impact of capacity withdrawal starting to take place. That continues to take place. But what do we have? We have an impending strike that could take place in the Midwest starting on Friday with the UAW strike. 144,000 members that are ready to go on strike if their demands are not met. Their demands are very, very large. They're looking for over a 40% pay increase with a 32-hour work week, not to mention the amount of hands that they want to keep on for electronic vehicles. That's going to be really tough to reach a negotiation on that point. We have heard that it will take place for one of the auto manufacturers at a time, strategically, interspaced. It is not expected it will take place at all three at the same time, which would have had a much, much, much larger magnitude. But at the same time, we do think that's going to decrease freight volumes out of the Midwest. As that decreases freight volumes out of the Midwest, we think that we are going to see large capacity carriers be forced into going into public load boards, be forced into reaching out to brokers. We've already had large carriers come to us and accept more freight out of the Midwest than they've accepted in the past. So that's been real. That's something that we've seen. So we've got a market that is ready to start popping. I mean, we have a market that is ready to start going. We have the contract load accepted value almost at 15,000. We have the OTVI almost at 12,000. There is so much that's pushing that way, particularly as capacity continues to exit and demand has been steady. But if we see this strike, that is going to put a big slowdown into all of this. Now, in the short term, yes, that is going to impact freight volumes and that is going to continue this freight recession. On the longer term, if this is to go for weeks, if we are to see the auto strike last for a sustained amount of time, that is going to take away from the volume that is necessary for these larger carriers to continue to keep that high level of employment. And you will see those larger carriers start to shed employment. That's really important because larger carriers are usually the last to have capacity be shed. But if they see this type of volume decrease, and they are faced with going to public load boards, broker freight, spot freight, etc., that is 15 to 20% below their cost to operate, well, we are talking about a different capacity environment. That's all I got for this week. Take care, everyone. Thank you very much. Talk to you soon.